Welcome to Learn Commerce PU online classes. Don't forget to like our video and subscribe our YouTube channel for all the updates.
Hello students, welcome to second PUC Accountancy online classes. Students, in the previous class we have solved problems up to 14, isn't it? Page number 124. Now, I'm going to take up problem number 15. Problem number 15. That is, I'll read out the problem, then I will analyze and let us solve the problem, right? From the following information, calculate debt to equity ratio and debt to capital employed ratio and total assets to debt ratio. Three ratios are asked. Seems to be new one, isn't it? Total assets given, current liabilities given, total debts given. That's all. Very simple. See, only three information. That's all. From that we have to calculate three ratios. So let us solve. You know that page number 124, I already told you. Problem number 15, correct? Problem number 15, page number 124 of your question bank. Let us solve. First ratio they asked was calculate debt to equity ratio. Debt to equity. Debt equity ratio. We have already solved debt equity ratio, isn't it, in our previous class. So, I'll write the formula, debt equity ratio. Under that, I'll write the formula first. What is the formula for debt equity ratio? Debt divided by equity, isn't it? Debt divided by equity. Divided by equity. So debt means long-term debt, right? Long-term debt divided by equity. So 6 lakh is the debt. 6 lakh is the amount of debt. That is, how will you find out? Total debts are given, right? 12 lakh. Out of which current liabilities are to be deducted. Total debt includes long term and short term, isn't it? That is a long term debt and short term debt or current liabilities. Non-current and current, both are called together total debts. So 12 lakh. Out of which short term debt is 6 lakh. So net amount is 6 lakh. So debt means long term debt. Long term debt. Nothing but that is total debt minus current liabilities. Current liabilities, right? Current liabilities. So it will be 12 lakh. 12 lakh minus 6 lakh. Minus 6 lakh. So that is debt. Then equity specifically given in the problem, is it? Equity specifically given in the problem. Whether it is given? No, it is not given. How to calculate equity now? How to calculate equity? Very simple. See, you know that total assets is equal to total liabilities. Total assets is equal to total liabilities. Isn't it? Total assets are given in the problem as how much? 15 lakh. Is that correct? 15 lakh is equal to, liability consists of, what are the three items comes under the liabilities? One is equity or shareholders funds plus non-current liabilities plus current liabilities. Am I correct? Current liabilities. Very simple. 15 lakh is equal to, equity is not given in the problem, question mark. Non-current liabilities is already known to us. How much it is? Non-current liabilities. How much? 6 lakh. Is that correct? Non-current liabilities 6 lakh. Current liabilities is a total debt it is given. Total debt, how much it is given? 12 lakh. That means current liabilities 6 lakh and non-current liabilities 6 lakh, right? So current liabilities 6 lakh, it is given in the problem indirectly, and current liabilities 6 lakh. Non-current and current liabilities. Now 15 lakh is equal to, isn't it? How much? Plus 12 lakh. Very simple. So is equal to 15 lakh minus 12 lakh is equal to 3 lakh. This is what equity is. Therefore, equity is rupees 3 lakh. Understood this? Very clearly given. Total liability, that is a total debt it is given. Total debt means non-current liabilities plus current liabilities, right? So 6 lakh each. Total it will be 12 lakhs. Total liability will be how much? Is equal to assets, isn't it? Total assets are given in the problem, 15 lakh. So 15 lakh minus 12 lakh is equal to 3 lakh is the equity. That is how you have to derive. Now substitute in the formula. Debt, you have already found out how much it is. Long term debt 6 lakh is equal to 6 lakh divided by equity, how much? 3 lakh. Correct? Is equal to how much? 2:1, isn't it? 2:1. This is, therefore, debt equity ratio is equal to 2:1. Debt equity ratio, right here, debt equity ratio is equal to 2:1. That is what you have to do. Correct? Yes. Then moving further, the other ratio they asked was interest coverage ratio. 10 times it is given. Interest coverage ratio, how much? No, not interest coverage, I'm sorry. Debt to capital employed ratio is asked, right? Debt to capital employed ratio is asked. So let us solve it. Debt to capital employed ratio. Take this as A, this is B. Debt to capital employed ratio. Debt to capital employed ratio. Under that, calculate debt divided by capital employed. That is debt is given in the problem as 12 lakh, correct? So write the formula first. Debt to capital employed. So capital employed means total assets. Am I correct? Capital employed means total assets. Right here, capital employed is equal to total assets or total liabilities. Both are one and the same, because always your total assets agrees with the total liabilities. Correct? Total assets. Total assets are given in the problem. Am I correct? Total assets are given as 15 lakh. So there is no headache for us. Then debt. Debt includes both. That is total debt here. Total debt. Long term and short term. That is long term liabilities and non-current liabilities and current liabilities. Right? So debt is equal to, right here within bracket, debt is equal to total debt. Total debt. So debt is 12 lakh is equal to, substitute the figures, 12 lakh divided by, what is the amount, that is a total asset, 15 lakh, right? 15 lakh is equal to 1 point, no, not 1 point, it is a 0.80 is to 1. 0.80 is to 1. Is to 1 is the debt to capital employed ratio. Right here, debt to capital employed ratio, DCER. Therefore, DCER is equal to 0.80 is to 1. So second that is part is done. Now moving on to last part, that is total assets to debt ratio. Total assets to debt ratio. I will erase this. Total assets to debt ratio, point C. Total assets to debt ratio is equal to, right here, total assets to debt ratio, TADR, total assets to debt ratio. Yes, write the formula. Total assets to debt ratio, total assets divided by long term debt. Formula is total assets divided by long term debt. Long term debt. Long term debt. So total assets are given in the problem and long term debt is also given in the problem. So it is not given directly, but you can derive it. Already you have calculated what is the total amount of long term debt and what is the total amount of short term debt, that is non-current liabilities and current liabilities. Am I correct? 6 lakh each. So substitute here, right here, given total assets, how much? Total assets 15 lakh, is that correct? Yes. Then long term debt is equal to 12 lakh minus short term debt minus 6 lakh, right? Current liabilities. So you will have is equal to 6 lakh. Now substitute the figures. Total assets, how much it is? 15 lakh divided by 15 lakh total assets, then I'm sorry, here you have to take not long-term debt. They asked us to calculate total assets to debt ratio. Debt means total debt. Total debt. You have to write here total assets to debt. So total assets divided by debt. Debt means total debt. So here it will be 12 lakh already given in the problem. Right here total debt. Total debt is 12 lakh given in the problem, right? Yes. So divided by 12 lakh. Now your work is easy. Therefore, total assets to debt ratio TADR is equal to, divide it and find out how much it is. I think it is 1.25. Yes, 1.25 is to 1 is to 1. That is the last ratio. So your problem number 15 is solved now, isn't it? We will move on to, that is section D. It is given, nothing is mentioned, marks question it is told. It will be mostly 12 marks question, remember this. Clear? Yes. I'll read out the problem, we'll analyze and then let us solve the problem. Following is the trading and profit and loss account for the year ending 31st March 2016, right? Opening stock is given. See, this is a T form balance sheet is given. Actually, they should not give T form balance sheet. It is not there nowadays because of that is change in the Companies Act, isn't it? Schedule 6 to Companies Act, which gives a particular form of balance sheet, which is called vertical balance sheet. In that form only they have to present. But problems like this, T form balance sheet, if it is given, you must solve because you have no option. Whatever question is given in the question paper, you must answer. Otherwise, you will get a big zero, isn't it? So you have to study this also. These type of problems also you have to study, so that you cannot say that it is not there. So no option for the students. So whatever is there in the question paper, you have to solve. Let us analyze this. Opening stock, purchases, gross profit, then sales are given, closing stock is there, then gross profit is brought down here, then expenses like administrative expenses, selling expenses, then interest and net profit is derived. Then they gave balance sheet in the T form itself. Capital is given, profit and loss account, creditors and bills payable, they are current liabilities, isn't it? Profit and loss account and capital, they are shareholders funds, very simple. Land and building, plant and machinery, furniture, fixed assets, tangible assets, stock, then sundry debtors, bills receivable, cash in hand, all are current assets. Let us see how to solve this problem, or what are the information that are asked. Calculate stock turnover ratio, trade receivable turnover ratio, trade payable turnover ratio, gross profit ratio, operating ratio and net profit ratio. These are the ratios that are asked in the problem, right? So let us start. Let us solve one by one. That is a turnover ratios are there. That is a stock turnover, debtors turnover, that's a trade receivable turnover ratio, payable turnover ratio, gross profit, net profit. These are all that is will be represented in the percentages, not in the that is ratios. Remember. Here, receivable turnover, trade receivable means debtors plus bills receivable, friends. Remember this. Trade receivable means it is not bills receivable, it includes both, that is debtors and bills receivable. And at the same time, payable, trade payable turnover ratio means that is creditors and bills payable. You have to add creditors and bills payable together. That is called, that is a trade payable turnover ratio. That is what we have to do here. Now, let us solve the problem. I'll take up the first one. Problem number, it is actually problem number 1 it is given, right? Because 12 marks problems, they are bifurcated, I think. Nothing is mentioned there. Marks problem, that's only there. Figure is not there, right? Yes. Let us stock turnover ratio. That's problem number 1. Under that A, stock turnover ratio. Stock turnover ratio. Stock turnover ratio, that is stock turnover ratio, STOR, isn't it? Write the formula, is equal to cost of revenue from operations divided by average inventory. Cost of revenue from operation, that is a STOR, is equal to cost of revenue from operations. What do you mean by revenue from operations? Revenue from operations means sales, isn't it? Cost means what? Cost of revenue from operations, very simple friends, sales minus gross profit. Sales minus gross profit is nothing but cost of revenue from operations. Revenue from operations divided by average inventory. Average inventory. Inventory means what? Stock. Inventory means stock. Here, average inventory in the sense opening debtors and opening bills receivable, opening debtors plus opening bills receivable plus closing debtors plus closing bills receivable divided by 2. That is what you have to do here. That is average inventory. When you take the opening balances and closing balances and when you add it together and when you divide it by 2, it becomes the average inventory. So starting how much was there and how much is there, add it together and divide it by 2, you will get the average stock, average inventory. So that is what average inventory is. Clear? So let us write here. Average inventory for cost of revenue from operations is equal to, right here, cost of revenue from operations. Don't get confused. Cost of, there is a revenue from operations means sales. Cost of revenue from operations. Remember friends, revenue from operations and cost of revenue from operations, there is a difference. Revenue from operations means sales. Cost of revenue from operations means only cost of sales, cost of goods sold, isn't it? That profit margin, all this will not come. So what we will do is we will take sales, that is a revenue from operations, minus gross profit, that is what is cost of goods sold. When you remove the profit part, that itself is the cost of goods sold. Very simple it is. So I will write here, cost of revenue from operations is equal to sales or revenue from operations minus gross profit. Sales minus gross profit. Now, gross profit is there in the problem, it is given in the problem, right? Yes, gross profit is 50,000 is given, sorry, not 50,000, it is gross, yes it is 50,000. 50,000 is given in the problem. Sales figure is also given 1 lakh. So let us derive this. Cost of revenue from operations is equal to sales, it is 1 lakh, am I correct? Yes, 1 lakh minus gross profit is 50,000, is that correct? 50,000. Therefore, cost of revenue from operations, that is cost of revenue from operations is equal to rupees 50,000. Very simple. One part is known to us, the upper part is known to us. Now let us move on to the lower part, that is average inventory. Remember friends, if opening stock and closing stock both are given, that is average inventory. Opening stock and closing stock are given in the problem, then it is, if we take the average of that, that is divided by 2, isn't it? That is average inventory. Stock inventory means stock here, so opening stock and closing stock you have to take. If opening stock is not given or it is nil, then take only closing stock, don't divide it by 2, take that itself as average inventory. I think I told you regarding debtors and creditors, isn't it? Turnover. but here we need that is a inventory, average inventory. So opening stock, if closing inventory is nil, dash, isn't it? Then take opening inventory as the average inventory. That is what you have to do here. Clear? So I will write here average inventory is equal to opening inventory plus closing inventory divided by 2 is equal to, write opening inventory as given in the problem, how much it is? 10,000 and closing 15,000. 10 plus 15 divided by 2 is equal to 12,500 rupees, 12,500, isn't it? Yes, 12,500. So now calculate, that is a stock turnover ratio, isn't it? We have both the figures here now. So stock turnover ratio is equal to cost of revenue from operations. How much it is? 50,000, right? 50,000 divided by average inventory, that is already we have calculated 12,500. Is it correct? 12,500 is equal to, therefore stock turnover ratio is equal to 4 times, isn't it? Yes. First part is done. Now second ratio we have to calculate. They told us to calculate which ratio? Trade receivable turnover ratio. Very simple, I already told you. Receivable turnover ratio, that is trade receivable turnover ratio. Yes, trade receivable turnover ratio. Trade receivable turnover ratio is equal to revenue from operations. So trade receivable turnover ratio, yes, net credit revenue from operations, revenue from operations divided by average trade receivables. Average trade receivable, isn't it? Yes, average trade receivable. This is what I was explaining. Average trade receivable means opening debtors and bills receivable plus closing debtors and bills receivable divided by 2, that is called average trade receivables. If debtors are not there or bills receivable are not there, then only the debtors or bills receivable alone will be, isn't it? Closing is not there, opening is only there, then that itself is the average. No need to divide it in that case. So let us write here on the other side what are the things that are required for us. Let us prepare. Net credit revenue from operations. Yes, see, when nothing is mentioned regarding cash or credit, entire sales should be treated as credit sales only. Remember, in this problem nothing is mentioned regarding how much is cash sales and how much is credit sales. Correct? In that case, treat the entire sales as credit sales. Otherwise, they should mention in the problem 25% of the sales are treated as cash sales. Then remaining 75% you have to calculate and you have to write here net credit. That is net credit sales, isn't it? Revenue from operations means sales, so net credit sales. So when cash sales are not given in the problem, then entire sales should be treated as credit sale only. So here revenue from operations is given in the problem. How much it is given? That is 1 lakh. Am I correct? Yes, 1 lakh is the revenue, net credit revenue from operations. Then average trade receivables, isn't it? Average trade receivables is equal to opening debtors plus opening bills receivable plus closing debtors plus closing bills receivable divided by 2. That is called average trade receivables. As in this problem, nothing is mentioned regarding opening and closing. Only the closing balance of debtors and bills receivables are given in the problem. Add it together, no need to divide it by 2. That itself is the average trade receivables. So in this problem, debtors plus bills receivable is equal to how much? Debtors plus bills receivable, sundry debtors 15 and bills receivable 12,500, right? Is equal to 27,500, friends. Correct? Yes. So 27,500 is the total of debtors and bills receivable. That itself is the average receivables, average trade receivables. Now substituting the formula, therefore trade receivables turnover ratio is equal to how much? Net credits revenue from operations 1 lakh, you know it very well, divided by average trade receivables we have already calculated 27,500. Now find out how much it is. 3.64, is that correct? 3.64 is equal to 3.64 times. When turnover is given, turnover is to be found out, then write it, represent it in the form of times, not is to 1. Remember, when you compare two figures, then you have to write it as is to, isn't it? Here you have to write times, number of times. So meaning is average trade receivables, that is trade receivable turnover ratio is what is the average collection time, isn't it? How many times we get the cash from the debtors, again we will give them credit, isn't it? Again they will pay the cash. How many times it happens in a year? That is 3.64 times, or almost 4 times, isn't it? Yes, that is what the solution is. Now let us move on to the next one, next ratio. I will deal with this. Yes. What is the next ratio? That is trade payable turnover ratio. It is very simple, friends. Point C, trade payables turnover ratio. Turnover ratio. Turnover ratio. That is, write the formula first. Trade payables turnover ratio TPTR, isn't it? So here write the formula first. Net credit purchases divided by average trade payables. Average trade payables in the same way whatever we did under, that is a receivables turnover ratio, in the same way. Here what you have to do is you have to take the purchases, isn't it? Average trade payables, that's a net credit purchases, whether it is mentioned cash or credit. If it is not mentioned, the entire purchases will be credit purchases. You have to treat in that way. Then average trade payables, you have to take both, that is creditors and bills payable, add it together. If opening and closing are not given, add it together and treat that itself as the average trade payables. If opening and closing both are given separately, then add both, that is creditors and bills payable, opening creditors and bills payable plus closing creditors and bills payable, and divide it by 2. Whatever amount you will get, that is called, that is average trade payables. Remember friends, in this problem such confusion is not there. So straight away add together and take itself as the average trade payables. Let me take up this, that is net credit purchases. Already I told you entire purchases here is credit purchase. You have to assume in that way 55,000, right? So net credit purchases is equal to rupees 55,555. Then average trade payables is equal to creditors plus bills payable, isn't it? Normally formula is average means, that is a total opening creditors plus opening bills payable plus closing creditors plus closing bills payable divided by 2. I will write this formula. Average trade payables means is equal to opening creditors plus opening bills payable plus closing creditors plus closing bills payable divided by 2. Opening creditors plus opening bills payable plus closing creditors plus closing bills payable divided by 2. That is called average trade payables. Isn't it? Now here in this problem, creditors plus bills payable, let us take it as see the balance sheet given. Creditors 25,000 and bills payable 15,000. 25 plus 15, therefore average trade payables is equal to rupees 40,000. Is that correct? Rupees 40,000. Now we have both the figures with us. Substitute in your formula and get the ratio. Now net credit purchases 55,000, therefore TPTR, trade payables turnover ratio, is equal to 55,000 divided by, we have found out, that is average trade payables, isn't it? 40,000. Calculate, that itself is the ratio. How much it will come? It will come as 1.38. Therefore TPTR is equal to 1.38 times. Whenever there is a ratio to be calculated on turnover, then represent it in the form of times, not is to 1. Remember, clear? Yes. Now next ratio will be gross profit ratio. Gross profit ratio. Very simple, friends. Gross profit ratio, that is a GPR, isn't it? GPR is equal to gross profit divided by net revenue from operations into 100. Gross profit divided by net revenue from operations into 100. Net revenue from operations means what? Revenue from operations means sales. Net revenue from operations means sales minus returns. Sales minus sales returns. If there are sales returns, deduct it and get the and take the net figure, net sales as your amount, isn't it? Net revenue from operations into 100. Now substitute the figures. You have both figures in your hand, isn't it? Net revenue from operations is there with you. That is 1 lakh. There are no returns, so it itself is the net amount. Then gross profit you have 50,000. So 1 lakh. GPR. Therefore, GPR is equal to gross profit is how much? 50,000. Is it correct? Yes, gross profit 50,000. 50,000 divided by net revenue from operations 1 lakh. 1 lakh into 100. Into 100, right? Yes. So it will be how much? 50%. Is that correct? 50%. Yes, it is. Is equal to 50%. That is, therefore, GPR is equal to 50%. Fourth one is done. Fifth one, right? That is operating ratio. Let us calculate operating ratio. I'll solve here. Operating ratio, point E, OR. OR is equal to, write the formula, operating ratio is equal to cost of revenue from operations plus operating expenses. Cost of revenue from operations, you know it very well. How to calculate? Sales minus gross profit. This revenue from operations minus gross profit is equal to cost of revenue from operations. Correct? Yes. Then you have to add operating expenses to that. Operating expenses. So write the formula. OR is equal to cost of revenue from operations. Revenue from operations plus operating expenses. Operating expenses. Operating expenses is very simple. That is selling expenses, distribution expenses, administrative expenses, isn't it? All these comes under the operating expenses. Here only two types of expenses are there. Interest will not come because it has nothing to do with the operation of the that is machine or operating of the goods, isn't it? Or manufacturing goods. Selling expense and administrative expenses, only two items are given over there. So administrative expenses is 15,000, friends, and selling expenses 12,000. It is alignment is missing here, so don't get confused. Administrative expense, it is given as 1,15,000. It is not. Actually, it is a total of the upper part. That is a trading part, isn't it? Trading account part it is. So make sure of it. Then there is a mistake. There is a mistake, that is answer trade receivable turnover ratio is given as is equal to 0.64. It is given. 3 is missing. Actually, it should be 3.64. Don't get confused. Clear? Yes. Now let us move on. Divided by net revenue from operations. Net revenue from operations. Net revenue from operations, you know it is 1 lakh only, because there are no sales returns. If there are returns, you have to deduct, and that it becomes net revenue from operations, isn't it? revenue from operations. So here, now let me write here cost of revenue from operations plus operating expenses, right? So OR is equal to cost of revenue from operations. You already calculated how much it is. Sales minus gross profit. Gross profit, isn't it? That is cost of revenue from operations. Revenue from operations is equal to sales minus gross profit, right? Yes, is equal to how much? 1 lakh minus 50,000. Sales, that is the revenue from operations, minus gross profit 50,000. So it is rupees 50,000. Right? Then net revenue from operations, it is there in the problem. No headache for us. What else we need? Then we need expenses, operating expenses, isn't it? Operating expenses is equal to administrative expenses plus selling expenses, right? Selling expenses. So it will be how much? Administrative expenses 15 and 12 plus 12 is equal to rupees 27,000. 27,000, right? Yes. Now let us calculate. Everything is ready. Masala is ready. Let us cook now, right? Operating OR is equal to operating ratio is equal to how much? Yes, 50,000 plus, that is cost of revenue from operation 50,000 plus operating expenses 27,000 divided by net revenue from operations. How much it is? That is 1 lakh. Am I correct? 1 lakh divided by 1 lakh into 100. Into 100 must be there. Therefore OR is equal to simplify it, you will get 77%. This is what the next ratio is. We have only one ratio left out, that is a net profit ratio. Am I correct? Net profit ratio. Let us solve that so that this problem gets solved. Net profit ratio. Yes, I will change here itself, right? Yes, formula is net profit ratio is equal to net profit divided by net revenue from operations into 100. That is the formula. Net profit divided by net revenue from operations into 100. Net profit is there in the problem. Then net revenue from operations means sales minus returns. It is there given in the problem. There are no sales returns. So whatever sales amount is given itself is net revenue. That is net revenue from operations. So therefore net profit ratio is equal to NPR is equal to net profit. How much? Net profit is 20,000. Is that correct? Yes. 20,000 divided by net revenue from operations. How much is it? 1 lakh? Yes, it is 1 lakh into 100. divided by 1 lakh into 100 is equal to, therefore NPR is equal to, how much it is? Is it 20%? Yes, it is 20%. Yes, with this your 12 marks first problem is solved. So this is how you have to solve a problem whenever 12 marks problem is asked. Here only the thing is that you should know the formula first of all, then whatever the items are there in the formula, you should know what information should be provided in that place, isn't it? That's the only thing you need. So take down assignment, solve this problem. 12 marks one, is problem number 1, 12 marks, isn't it? And submit assignment on time. Thank you for watching this video. Thank you.
Don't forget to like our video and subscribe our YouTube channel for all the updates.